Yesterday on our news section of goldsilver.com, I saw one of the scariest charts that I've ever seen. And I sort of haunt the Fed's website now and then, poking around and looking at charts. And repurchase agreements and reverse repurchase agreements are part of what's called open market operations. And they allow the Fed to sort of control interest rates through these open market operations. But what I wanted to point out to you is this chart here on this article. And in the red oval here, this is the crisis of 2008. And the amount of repurchase agreements has been at a higher plateau since then. But this has been part of Ben Bernanke's response to the crisis of 2008. But for the last, since January of 2014, it appears like the Fed is losing control. These are huge spikes. One here, they added 279 billion in 2 weeks. And then just over the past couple of weeks, they added another 405 billion. That's 0.4 trillion. Now, in the article, it says, we know that in 2008, there was a derivatives counterparty default meltdown. This required the Fed to inject Treasury collateral into the banking system, which could be used as margin collateral by banks or hedge funds / financial firms holding losing derivatives positions, or to patch up counterparty defaults like AIG Goldman. And, at the end of the article, without a doubt, the graphs above are telling us that something broke in the banking system, which necessitated the biggest injection of Treasury collateral in history into the global banking system. And if you go to the Fed's website, you can get the definitions of repurchase agreements and reverse repurchase agreements. But the repurchase agreement is a transaction in which securities are purchased from a bank and the Fed pushes cash onto the balance sheet. They buy the Treasury bond with cash, and so the bank now has more cash but less high-quality collateral. And then the bank promises to repurchase that in a specified number of days. Most of them are 14 days, but a lot of them are overnight repurchase agreements. They can be up to 65 days. But when you go to reverse repurchase agreements, this is where the transactions in which securities are sold. So the Federal Reserve is selling Treasury bonds to the banks, and the banks are promising to sell those bonds back to the Federal Reserve at a later date. So this pulls cash off of the bank's balance sheet, but it gives them high-quality collateral to put up, like for a losing derivatives position or something like that. So what I find interesting here, when you're on the Fed's website, you can go along and see the different dates. And for back in 2004, we were averaging about $20 billion of reverse repos. Now this is the total amount outstanding, and these are rolled over constantly. Sometimes they aren't rolled over, in which case this line declines. But then most of the time they keep on adding to it. And in the crisis of '08, we went from about 45 billion up to 107 billion at the peak. I can't quite hit that peak here right now, but it was 107 billion. So they added about 60 some billion to it during the crisis of '08. And then you get out to January 1 of 2014, and the total goes up to 315 billion. And then there's another crisis, December 31st, or I'm sorry, this is December 31st, 2014, 509 billion. And then as of September 30th, we're at 600 right here. we're at 641 millions of dollars, which means it's 6,041 millions. So this is 641 billion. That's 0.6 trillion of these repurchase agreements. So the Federal Reserve just shoved over $400 billion, 0.4 trillion of treasuries onto some banks' balance sheets as an emergency maneuver. When you go to the Fed's website, it's really nice. You can zoom in on certain areas here, and you can see just what the crisis of 2008, how they responded there. And then you look at the size, the scale of what is happening now. And the reason this is scary is because the Fed doesn't tell us what's happening. They keep us all in the dark, and they just publish these results that sort of point to, oh, there is something happening out there, and we don't know what it is. But what is happening right now, the Fed is trying to gain more and more control. They want to steer the free market. And so it's no longer a free market. And Ben Bernanke's responses to the crisis of '08 gives the Fed so much more management over the economy and the market than they had before 2008. And they don't realize that their controls are much worse than just letting the free market work, that their controls don't really work. And what you're seeing right now is they're responding to emergencies that are happening one after another. Something is coming. These are warning signs. And, the crisis of the crash in 2000 of the NASDAQ and the recession in 2001, 2002, that was Alan Greenspan's making. And then the crisis of '08 was also of Alan Greenspan's making, but Ben Bernanke, charged in with all of these remedies that then are just magnifying. He's creating the Bernanke bust. And the Bernanke bust is coming very soon to a monetary system near you. I don't think we've got a whole lot of time left before something really disastrous happens to the monetary system. So I wish I had better news for you, but we'll see what happens with these repurchase agreements and if this comes back down sometime soon, or if there's a blow up in the financial system coming in just the next few months. So subscribe to the channel, and we'll see you next time. Thanks.